Welcome to the Wise World Investment Planning Town Hall presentation for the second quarter of 2021. Our focus today will be tax planning and cash flow. Yes, taxes could rise. We're watching the channel. If you make more than $400,000 a year, you might have crosshairs on your back. Let's dive in and have a little fun. The largest single source of revenue for the United States government is, yes, you bet, income taxes, corporate taxes, personal income taxes. As you know, long-term capital gains rates and qualified dividends, if you make more than $1 million in taxable income, could change significantly. We're talking 20% capital gains up to 40%. Let's see how the current administration handles that. So that is something we are monitoring on your behalf. We also are looking to see if there's a repeal of the TCJA tax cuts, the ones that Trump put in, for any income taxpayers over $400,000. You could jump from a 37% tax bracket up to the brand new, or welcome back, I should say, 39.6% bracket. We're monitoring that as well on your behalf. Another current personal income tax provision that we need to all consider is the P's limitation, which put a cap on how much certain taxpayers could claim in the way of itemized deductions before it was repealed when President Donald Trump signed the Tax Cuts and Jobs Act, also known as the TCJA, into law on December 22nd, 2017. As you can see on the slide, reinstituting the P's limitations on itemized deductions for taxpayers with income over $400K, and also capping the value of itemized deductions at the 28% value is what we're looking at to see if Congress makes that happen. Under the current law, itemized deductions are not subject to this limitation. Deductions are valued at the taxpayer's top marginal rate, but we'll see how that changes in the not too distant future. QBI, yes, we need one more acronym in our life. Qualified Business Income, also known as Section 199A. Your accountants are having a lot of fun with this and have been for the last couple of years. A deduction for taxpayers with income over $400,000. The QBI deduction is for taxpayers who report business income from pass-through entities such as LLCs, limited liability companies, and S corporations on their personal returns. There is a good possibility they're going to eliminate the tax deductibility for 401k, IRA contributions, and replace the deduction with a credit equal to the amount of the contribution multiplied by a fixed percentage. By the way, this fixed percentage would be lower, perhaps significantly lower, than the high income marginal rate. This is why you work with tax professionals, because this is a dynamic piece of law that's changing beneath our feet as we're sitting here today. This slide could be a potential problem because they are contemplating, Congress, changing the step-up in basis at death rule. Let me give you a quick example so we have a clear understanding on this. Let's assume that your parents purchased their home, 30 years ago, and let's assume they bought it for $50K. I'm just making up figures for this example. 30 years later, you end up inheriting your parents' home. It's now worth a value of, let's say, $1 million. Step up in basis works as follows. You basically do not have to pay taxes on the difference between 50 and $1 million. The basis steps up to the value of the home at the date of death. So when the last parent passes away, let's say the home's worth $1 million, the heirs get together 9 months later, let's say, sell it for $1 million, you'd have zero taxes. That's the law today. What they're contemplating or considering doing is literally moving that down to you would pay taxes on the difference between $50,000 and $1 million. That would put you in the 40% tax bracket. You'd owe $400,000 on that transaction. You can see how if you do enough of those, that actually generates quite a bit of revenue for our government. We are definitely monitoring this channel on your behalf. A nice personal income tax provision that exists today is something called the 1031 exchange. And some of you have used that, where you own a property, you don't want to pay taxes on it quite yet. So instead of selling it and causing the taxes to be due, you would exchange it for a different like kind property. So rental property to rental property, cattle ranch to cattle ranch, etc. They're talking about limiting this or taking it away altogether. That is really going to impact the real estate market. Again, something to watch for active tax planning. All right, if you're the owner of a corporation, then you know your top rate right now is currently 21%. They are absolutely actively considering moving that top rate to 28%. Is that likely? Well, good question. If you notice from the chart of U.S. corporate tax rates below that start in 1909 on the far left to 2018 on the far right, it was not uncommon to have really high corporate tax rates historically. The only thing you need to get out of this chart is you can see higher rates in the past, and you can see the rates have been coming down steadily since. The question is, does the legislative memory remember those higher rates? Okay, maybe we ought to get back there one of these days. And maybe one of those days will be sooner than you think. This is not a time to panic. This is a time to plan, especially when it comes to taxes. So when it comes to estate and gift taxes, right now, most of us on this call do not have an estate tax problem because you got a nice credit of $5.8 million individually. If you're happily married, obviously that doubles to the 11.6. That will cover most of us. But remember, historically, that rate used to be as low as $600,000. So they protected us for the time being. How long will the estate and gift tax be protected? Only time will tell. Most of us are impacted by this slide. When it comes to payroll tax, you're either an employee or you're an employer. So as you know, current payroll taxes are subject over $400,000 to the 6.2 Social Security payroll tax. Self-employment income would be subject to this tax as well. Over $400,000, 12.4, you've got to pay the 6.2 for the employee, 6.2 for the employer. That's how we got to the 12.4. This creates a donut hole in how these taxes would apply. Individuals would subject to taxes on wages and self-employment from $0 to $137,000 and from $400,000 upwards. For individuals and businesses considering tax planning, and that's most of us today, a key issue is the effective date of any tax increase or change to the deduction scheme. In situations where taxpayers have control over the timing of income and deductions, taxpayers may be able to effectively choose their income tax rate. The rates currently effective in 2020, 2021, or beyond. But making this choice would mean accelerating income and paying income tax earlier than would otherwise be necessary. This means, of course, giving up the advantage of income tax deferral, which is the best way to decrease a taxpayer's effective tax rate. So bottom line, timing matters. So the Tax Cuts and Jobs Act that was enacted while President Trump was in office, how's it going to be impacted now with our new Commander-in-Chief, President Joe Biden? Well, as you can see, high on the Democrats' priority list of legislation is, and continues to be, should they cut what Trump did, Tax Cuts and Jobs Act, which, as you remember, lowered the taxes on high-income individuals and businesses. This is a priority shared by most Democrats, not surprising, but members of the Democratic caucus are not in agreement on the proposed tax policy agenda items that go even further than the repeal of the Tax Cut and Jobs Act, such as taxing capital gains and dividends at the same rate as ordinary income for taxpayers with more than $1 million in income. So this won't impact all of us, but we are monitoring it for those of us that it directly impacts. As you're most likely aware, the Democrats took the House, the Senate, and there will almost certainly be tax reform, and income taxes will increase on high net worth individuals and businesses. We see the ultimate outcome as somewhere in the middle between a repeal of the TJCA and Biden's proposal. The effective long-term capital gains rate increases. Perhaps just a redefinition of what long-term is, and probably some rate changes as well. Not eliminating the preferred rate on capital gains and dividends. At least some deductions are limited, perhaps with the reinstatement of the P's limitation or some sort of negative adjustment and loss of the QBI deduction. The state and local tax deduction will be reinstated and the charitable deduction will be protected. Yay! And perhaps even expanded. We can look forward to that. The overall result would be a tax reform that is far from significant, progressively promised in the current Biden proposal. But there might be a rate increase nevertheless. Here we go. For estate taxation, beyond the repeal of the TCJA, which could happen quickly and include the loss of the double gift and the estate tax exemption, observers currently do not see much in the way of additional reform. That could be good news. Increasing the estate tax may be popular among a certain branch of the Democratic caucus, but there is a realization that the relatively small amount of revenue is not worth the internal fight and struggle as compared to the other revenue raisers. The estate tax increases will raise unpopular issues, family farms, the definition of small businesses, vacation homes, etc. To make estate tax changes not worth the amount of the debate. Although this may be the case, clients, you, should very much consider estate planning before the end of this year, and every year is just good proactive planning. Capital gains, that's when you and I are investors and we buy something and intend on holding it for more than 365 days, also known as a year. Capital gains rates, which are lower than a taxpayer's ordinary income rate most of the time, depending on the taxpayer's taxable income and filing status. The maximum adjusted capital gains rate apply for both regular income tax and for the AMT or alternative minimum tax. For 2021, the maximum zero rate amount on adjusted net capital gains will be $80,800 for married, half of that $40,400 for married, etc. Now there is a magic figure, $445,850, in case you want to memorize that one. That is the taxable income level that triggers the maximum capital gains of 20% for an individual. For married people filing jointly, the amount is $501,600. So if you're in those ranges, there's a target on your back. Sorry about that. The 15% rate amount will apply to adjusted net capital gains up to $501,600 for joint, $258,000 for married individual separate returns, $473,750 for HOH or head of households, and $445,850 for single individual returns. Above these ceilings, the applicable capital gains rate is now currently set at 20. There's talk about moving it to 40 if you make more than $1 million. We'll continue to monitor this channel for you. To leave no stone unturned, the IRS is also making changes to our beloved retirement plans. So the IRS also announced the 2021 limitations on retirement plan contributions and their phase-out ranges. The income exclusion for employee contributions to employer retirement plans such as 401ks, 403bs, 457s, and the government's thrift savings plans, for those of you that participate in those, will remain at $19,500. The catch-up contribution for employees 50 and older, you're supposed to be in a catch-up phase, will continue at $6,500. For simple retirement plans, the limitation will remain at $13,500. So those are the facts and figures. You're up to date. Although the deductible amount for the IRA contributions will remain at $6,000, with the catch-up contributions for individuals age 50 or over will be $1,000. The phase-out levels for the deduction are adjusted upwards. If either a taxpayer or their significant other or spouse, let's just say spouse, is covered by a workplace retirement plan during the year, the deduction may be reduced or phased out until it is eliminated. So this has been the law of the land for a while. Just a quick little refresher. Taxes are obviously important to each and every one of us because we have the same Uncle Sam. However, cash flow, I would contend, is just as important as taxes. So, how's your financial statement? How's your cash flow, balance sheet, income, and equity growth? Let's get started. So, your statement of cash flow. If you live in the desert, you might want to have water. Well, if you live anywhere for that matter, you want to have water. Cash flow is kind of like your version of water. It consists of an income statement, a balance sheet, and cash flow. These are some of the parts that I'm sure most of you are familiar with. Some of you use these heavily every day. Some of you get a chance to glance through them. Sales revenue. So looking at the top item on the income statement. Are you producing lift? Is your aircraft flying? Do you have any sales from product or services? What's the growth rate? What's the profit to sales ratio? So take a look or make sure your team is looking at your sales revenue. What are the cost of sales? It takes money to make money sometimes. What are your overhead? That's kind of like the fuselage of the aircraft. How many people do you have on board? What's it cost to have those great talented people in and around you? Depreciation is an accounting term that goes on your income statement. EBITDA, earnings before income tax, another part of the calculation. Income from interest, hopefully you have money making money for you. How hard is your money working for you as part of your cash flow in your income statement? profit before taxes, obviously. We've been talking about taxes. What are your tax expenditures? And what's your bottom line result? There's a quick overview of the income statement. We will now transition over to the center, which is the balance sheet. Do you have any receivables, stocks, payables, real estate? What is on your balance sheet as you go through? Obviously, the balance sheet and the income statement work together. So we've looked briefly at income statement, we looked at balance sheet, the bottom line is cash flow. So are there receivables? Anybody owe you any money? Anything changing that way? Any changes on the balance sheet? How's that going to impact your cash flow? And by the way, you can't guesstimate this. This is time to do the measurements, time to do the accounting. Make sure you got it. Any payable changes? Operational cash flow, don't do it in your head. Go look at the numbers. Are your investments doing what they're supposed to be doing? We're here to assist. Requirements for liquid versus illiquid funds. You've got to have liquidity all times or we run out of drinkable water. Any financing charges, related issues on borrowing, and then liquid fund changes. So that's kind of a quick little executive summary for you today on statement of cash flow, income statement, balance sheet, and cash flow proper. Some of you today are enjoying this topic of taxes and cash flow and having the time of your life. Others, your head is spinning. Perfectly get it. I've been in both cases at different stages in my life. So as we dive into the statement of cash flow, again, income statement, balance sheet, and cash flow, this is another way of looking at it. So I've done an entirely different format for you now. Again, sales revenue, cost of goods sold, overhead costs. Some of you are like, I get this. I like this. I eat this up. I live this every single day. Others are like, I'm glad somebody else is tracking it. So whichever camp you find yourself in, here's a nice picture view, step-by-step, living, breathing checklist of your income statement, your balance sheet, and your cash flow. And this will be part of our conversations we have throughout the year. Enjoy. Go to any bookstore and you will find purple books in the finance section. Yes, it's Robert Kiyosaki and Rich Dad, Poor Dad. This is where I originally came across this concept and wanted to share it with you today. I'm not sure he originated it, but he had the most fun with it. So the cash flow quadrant, 4 sections quadrant, basically says most of us start in the upper left. You have a job. Anybody here raise your hand if you've had a job or you have one now. You're trading your time for money. You started as an employee. So congratulations. Most all of us have been in quadrant E of the cash flow quadrant. Then some of us have jumped down to the self-employed, where you now have your own job because you've created it, time for money. Hopefully you're making progress. Then you go from the E, the S, you leapfrog up to the B, you become a business owner, yay, with all the privileges and responsibilities hitherto entitled. People work for you, you have people, more leverage, more headaches, more rewards, and eventually you get to investor, I. And that's where some of you have jumped right from E to I because you said, I've been an employee and I just want to be an investor and I don't want to do anything in the self-employed world. So whether you do ESBI or whether you go from E to I, I'm here to help all the I's. As most of you know, our offices are located here in beautiful Arizona, where water is mission critical, and I would challenge you that cash flow is too. Many of the lakes here are linked, canyons, saguaro, one reservoir after another, all beautifully linked together to make sure the Valley of the Sun has water. Well, you should have reservoirs as well. You should have cash reservoirs. Most of you started with checking and savings, great place. And then maybe a reservoir after checking that's a buffer between you and the market. And then maybe your retirement and your stock market accounts. So having a reservoir system really helps with cash flow planning. We're here to double check and make sure all your reservoirs are filled with water, i.e. cash flow, and they're all working as intended. So the proverbial piggy bank, most Americans are saving more than ever. Actually, most of the people on the planet are, because we're not spending money on vacations and travel, and we've got a lot of pent-up demand, as you realize. So what are we doing to boost our financial health? Well, make managing your finances more routine. Start dollar cost averaging. Add money on a routine basis while you can. Let's become the best savers on the planet. Quarterly visits can help with that. Use the power of the cloud. Right now, most of us have digital lobbies and we're doing things with Zoom and electronics. Have fun with that. That's a good money saver that'll help with cash flow. Get the most out of your money by letting Wise World Investment Planning assist you with that. Use the data. As you know, you start with data, go to information, then knowledge, then eventually wisdom. It's a 4-step, 4-tiered process. And please continue to adapt to regulatory requirements because they have a full-time job and we have a full-time job cooperatively to make sure everything is hunky-dory, T's are crossed, I's are dotted. Cash flow, boost your financial health. Thanks for listening to Townhall Q2 2021. And now the official disclaimer. The opinions voiced in this recording are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategy or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Thanks.